Right, guys and girls, so now we are into episode 4, which is probability, one of the most important things. So what I'm going to do is I'm going to run through all of these concepts, and then at the end we're going to go into a very, very powerful mini lesson on probabilities, including parts of psychology that are absolutely crucial for your success as a trader. But first up, let's take a look at the edge. What does an edge mean? Well, essentially, your edge is the upper hand that you will have in the markets. With the Falcon strategy, we are constantly maximizing our reward and mitigating our risks by utilizing the 1% model. This means that no matter how much capital you're trading, you're only ever risking 1% of the total amount. But through practice and backtesting, constant refinement, positions grow larger, risking 1% per position, while winners begin to bank in excess of 10% for a single trade. So you're keeping that risk small and you're keeping your reward higher. Returns vary among members and experience levels, but are consistent traders who have learned and mastered the Falcon style and proven the potential within the strategy. We do not set limiting beliefs within Falcon. We focus on growth, progression, and evolving you into best possible trader you can be. Somebody who's a trader that's making 15% per month on average doesn't mean that happens to be a better trader than someone who's making 12% per month on average. It's not a competition. It's about consistency, and it's uncapped. You can become the best version of yourself. And as you learn to trade more capital, that's a huge thing as well, because you need to learn how to deal with the emotional side of it, which we help you with. But more into the edge. So having an edge in the market can easily be explained by relating how casinos operate on a daily basis. Think about it. Casinos do not know for a certain outcome of any given transaction. However, what they do know is that over a large set of data, they will always remain profitable. This is the casino's edge. And the same is true within trading Forex. When you develop your skill set to a certain level, you can trade with clarity and confidence in knowing your edge will play out over time. Chances are you'll have an automatic reaction or feeling to the outcome being either a win or a loss. The main thing you need to keep in mind as a trader coming into Falcon is that you need to learn to manage your emotional response to the outcome of your trades, regardless of the result. So not being overly happy when you win or overly sad when you lose. It's more of that balanced mindset, which takes time to develop. It doesn't happen straight away. Your edge will play out, and within the Falcon strategy, you will clearly begin to see that you develop your skill set, your edge and strike rate within the markets also begins to increase. So that is really what having an edge in the market means. And moving forward to that, let's take a look at the actual probability model. So probability model. All traders work on the probability model. The error that the vast majority of new traders make is the exception to make it quick and easy money. Not that that's not possible and people haven't, turned small accounts into large accounts, but rather it's the wrong headspace to be in from the beginning. Our focus in Falcon is to maximize profitability within a risk managed strategy. Essentially, we're risk managers. The probability model just refers to the fact that you never know with 100% certainty that the trade will play out within your favor. We as traders, we work on this probability model, pushing our edge in the favor as much as possible as we can, so we can constantly enhance the reward by keeping that fixed management model. This is a long-term sustainable wealth building vehicle. When you start to factor in compound interest at plus 10 and 15% returns on a monthly basis begin to add up very quickly. Pour your time and effort into learning the ins and outs of FX trading, because the rewards are limitless when you focus on becoming the asset, which is what we talk about on a regular basis. So that is the probability model. Now let's move on to risk versus reward. So risk versus reward. So how do we look at that? Well, often expressed as a ratio. So example, 1-to-1, 2-to-1, 5-to-1, etc., etc. The risk to reward of any given trade is very important to us. This allows us to determine whether or not it's worth the investment to enter the outline trade, essentially. Typically, we will target positions offering at least a 3-to-1 risk to reward ratio. This puts the mathematics in our favor. One key point to remember here is that risk is always capped at 1%. We do not maximize. We do this to maximize our upside, essentially, and we increase our edge to consistently do this in our routine. And if you keep your risk low and you have a minimum risk reward of 3-to-1, you're always putting that in your favor mathematically, right? Utilizing many different aspects of our strategy allows us to keep our risk managed in ways that other strategies do not, making for a more profitable and more risk-adverse trade environment, which is what we want for longer-term results. Risk versus reward is the basis to how your mind will begin to operate trading the financial markets. Now let's cover some common misconceptions about trading. I think this is really, really important. So we're going towards the trading myths. So what are the trading myths? For the uneducated, yes, trading in that case is most definitely gambling. Risking large portions of an account with no risk management is a proper way to blow your entire account. And this kind of falls into that 90-90-90 rule where they have no strategy whatsoever. The myths you've heard about trading are from those that have not been properly educated, and they're approaching the market blindly, expecting the overnight payday. Probably watched a few couple of episodes on YouTube, opened up an account, and again, they're risking 10-20% of their account. No wonder they fall into this category. If someone started a business that way, it would be exactly the same thing. They would lose. Through Falcon, you'll continue the mindset techniques to brush these kind of comments to the side and focus purely on your acceleration and profitability as a long-term trader of becoming that asset and build your portfolio over time. The beautiful thing about being a Falcon member is the access to the supportive worldwide community. Surrounding yourself with like-minded people that have similar interests and intentions is a massive step in the right direction. As they say, you are the average of the 5 people you surround yourself with. And if you're in a community of 6-7 figure plus traders, then you're on the right path. So myths about trading. For the educated, trading is most certainly not gambling. Being a consistently profitable FX trader is the result of developing a bulletproof mindset and investing the time up front to invest in your skill set. It's constant hard work and refinement. And it's very, very enjoyable, and you'll learn to love this. Approach trading like a business. As we always say, treat trading like a business. There will be costs, investments, and hours put in, but at the end of the day, it still turns into profit. With trading, that profit and that growth curve becomes exponential once you're consistent, because the scale and the power of compound interest calculated is just huge. But it really is about applying yourself and seeing everything what you're doing as an investment. Your education, that's an investment. Over the years, I've probably spent about £20,000 to £25,000 from when I started at 18 years old in investing in courses. Now, I may not be trading that way right now, but I've learned so many things along the way. And it's because from a very, very young age, I saw it as I'm investing in myself to learn. And all of these key components, softwares, you're investing in yourself. You're investing your time. We cover compound interest, and we showed you that in a lot of detail. And when you can really, really understand the key lessons about compounding that account, I think that's the most important thing, because then you're not fixated on, I have to have a large amount of money to trade right now. You don't, right? And we go into more detail of this in the course. So the most important thing to take away from this section is the fact that no matter what, there will always be people around you that will inflict their limited mindset on your interests, and they'll work to put that into the markets. The key is to build a bulletproof mindset and start to embrace like-minded people while filtering who you spend your time with. Remember, people fear what they do not understand, but if you approach it the right way, there's always incredible business-like people to do that, and we have an incredible community with those people. So that's really the myths of trading that we really want to put to bed, because it's what holds people's back, and if you've got family and friends, that you look up to and they don't understand it, they're not going to have a positive opinion. But it's the same for everything. It's about seeing through the noise and focusing on the right way, which is why we treat things very professionally. And we don't focus on, pips and monetary value and that kind of stuff. We keep it low key, focusing on the right things, and build some serious wealth, not short-term wealth. So probability. Probability can seem like a minor topic at first, but in fact, it plays into some major components of what makes a successful trader. One of the biggest things, with that being said, we will cover handling emotion in more detail in episode 9, which is psychology, which you're going to absolutely love, and it really builds into more psychology. The important thing to know is that you'll never know with certainty the direction of a trade. You can't ever fully know that. The market does not provide us with certainty. And it's our mission as traders to outline highly probable setups through our strategy criteria, and it allows us to increase that risk to reward ratio with our wins and with our losses. Emotions can often affect our ability to determine the validity of positions we're looking at. So essentially affecting our decision-making process, and in turn leading to more risk exposure to losses. This is why managing your emotions is so key. It's not about control. Learn to manage your emotions. By training to manage your emotional swings rather than control them, we're training our mind to stay neutral and let the reliance fall on probability and our ability to stick to the strategy. That takes time, but once you fully grasp that, you'll see how powerful that is. What I've put together now is an incredible mini lesson breaking this down with lots of psychology that really shows you the key components of how to think in probability. So let's take a look at that now. Right guys, so now you understand briefly what probabilities means. Let's take a look at this on the whiteboard so we can go a little bit deeper into it. So first up, coin theory. Really important to summarize this and understand this concept. So in order for us to understand the sequences of probabilities, we first need to understand what an edge means within the market. So let's look at it from a coin. Let's say, for example, we have a coin, we flipped that 100 times. If we was to look at probability, we would probably all agree 50-50, right? 50% heads, 50% tails. But you wouldn't be able to tell me the exact order of those flips, would you? Now let's take that one step further and we look at coin theory. So coin theory suggests that if you have heads weighted 70%, what would be the ratio then if we was to flip that 100 times? I'm sure we would all bank on heads, 70-30. So if we flip it 100 times, 70% of the time it will be heads. That is the Falcon strategy. That is your edge within the markets. So once you know that you have a formula that works, something that's proven, that's tested, that you know that it's going to give you an edge over a large sample size of data, it then goes into probabilities. So most people think they think in probabilities, but they don't. So we're going to cover with some simple exercises here and really take a look at this to really gear your mind into thinking more in probabilities, because that gives you the best chance to succeed. So let's take a look at the sequences that we have here. So we have month 1, 2, and 3. So what this represents is 10 coins. As you can see, I've got loss, wins, and the B represent break-even trades. So what we're going to look at here is the sequence of how does this tie in and how does this actually feel when you're trading. So when it comes to trading, what do we know and what we don't know? So we don't know the exact sequence of our wins and losses, and we don't know when they're going to occur. So for example, if you're trading, let's take a look at this first part here. Do you know that these first 2 losses are going to be in the first week of the month, or are they going to be in the first day where you take 2 losses in a row, and then for 4 days later, then you take the next trade? That's something that we can't control and we can't force, and we shouldn't force. So we don't know the frequency as to when that happens. And it's important to understand the psychology through that whole process. So let's actually take a look at this. So let's say month 1, we have loss, loss, win, win, loss, win, break even, loss, loss, break even. How do you think that would feel emotionally if you was trading? Think about it. You start the month off, loss, loss. What kind of mind frame would you be in then? Realizing that, well, let's take a look at this whole process. If your average risk to reward is 3%, 3 to 1, which is what we look at within Falcon, and generally speaking, it's even more than that, but let's just take a base layer of 3 to 1. Minus 1%, you lost. Minus 1%, loss. 3, 3, loss. 3, break even. Minus 1, break even. So you can see even here, at 3%, 3%, 3%, you're looking at 9%. Now, how many losses have we got? 1, 2, 3, 4, 5. So we've got a net 4% profit. So even though you only technically had 3 wins in this process, and you had break-evens and losses, even on that strike rate, you're still profitable. But it's the thought process leading into this and understanding that we do not know these sequences of wins and losses. You don't know which trade it's going to come, which leads me on to the second month. Second month here. Now imagine that we start off break even, loss, break even. How do you think someone's feeling right now? Emotional, maybe questioning their trading plan, maybe questioning the strategy, thinking, what have I done wrong? You're in a fear-based mindset. When really and truly, this is where we want to gear our minds to understand that, well, let's look to see if this month can be profitable. So we look at the W here, so win, win, win. Now 3 wins in a row, 3, 3, 3, looking at 9, break even, another win, 12. So then we've got 12% minus 2. We're at net 10% profit. Now, did that really feel like net 10% in the beginning? Probably not, right? Fearing a little bit, right, break even, loss, break even, feeling like you're going in a downward spiral. Really and truly, these could be the highest quality of setups, but they just don't play out in the beginning, and that's okay. This could be your first week of the month. This is why we say, don't judge yourself every single day, every single week, or even every month. Judge yourself quarterly, because as you can see, month 1, month 2, month 3. And if you group this all together, this is going to give you a quarter to then average that out. Then moving on to the last part, which is the third month, if you take a look at here. So if we can see here, we've got win, 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 break even, 3 losses and a break even. This is one of the most important things to understand here, because this is where the cockiness, the invincible kind of mindset comes in, because you win, 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 break even, win. You think you're just onto a winning streak in that sense and that you can never lose. That kind of sometimes encourages you to take reckless trades. So this is where processes over outcome-driven mindset is so important. So what do I mean by that? Right now, to get these wins, you're sticking to a good process. What happens halfway through the month, essentially? Well, you kind of go from, let's say you're sitting at, let's say on these, because you're not going to get 3% every single time. Let's say that we had 2% on average on each of these wins. So we're looking at 2, 2, 2, 2. So we're looking at 8%. So at this point, you're sitting at 8%. You could be towards the end of the month, maybe 4 days to the end of the month, and your mind starts shifting into this, well, I'm up 8%, but I want to be a double-digit a month trader. And you start forcing things. So you can see what happens there. You go from being a process-based trader, which got you here in the first place, and you're up 8% for the month. Now you go outcome-driven. What happens? Reckless trade, reckless trade, reckless trade. These could be high-quality trades, but you understand the thought process. It's really important to gear your mind more so in this sequence in month 3 that we're looking at here, to really remain process-driven and remind yourself, right, is this trade actually in my plan? Does this make sense? Does this fit the criteria? Going through that trading checklist all the way through is so important. So understanding all of that, I think we can all agree now, we don't know when exactly our wins and losses are going to come, but we do know that the system works, and it's important that you remain process driven throughout of this. Then you can average out over the 3-month period and take a look quarterly, which is where you really want to measure yourself. But now let's take a look at how that kind of ties into, well, what would an inconsistent trader versus a consistent trader, what would they fall into that would really hinder this? So let's take a look at it. So firstly, on the inconsistent trader side, we're looking at too many valid trades. So as you know, if you're taking too many valid trades, then you know your ratio is skewed. You want to be taking higher quality trades, but still having valid trades in there. So for example, you could be taking this, let's actually take a look at this part. This is even more interesting. So let's say, for example, you're taking too many valid trades in this month 3, and you actually have a good sequence of wins. So win, 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 break even, win. And these valid trades are kind of just low quality valid trades that don't really have that much room. They don't have the high time frame structure. There's not that room for them to go. So essentially you just walk away with pretty much a 1-to-1 on each one of those. Then 1%, 1%, 1%, 4, take 3 losses, you're back at around, plus 1%, for example. You finish on a very low month, when really that could be the difference of focusing on high quality, which is more your 80-20. So moving over to the consistent trader's mindset of, no, I want these to be high quality. I want my ratio to be 80% on average high probability setups and 20% valid trades. So then this probability here is then skewed in the right way. Now, it's not to say that a valid trade can't bank you returns of 5%, things like that, because sometimes it does, but this is over a larger sample size. You really want to be looking at the 80-20. Then we move on to what I spoke about earlier with the 1-to-1 risk to reward. You're literally focusing on your 1-to-1s. So rather than looking at a minimum of a 3-to-1, which is where you really want to be focusing on, your mind goes, well, I'm in 1% profit, maybe I should bank it now. This is where people manually close trades a little bit early and then cut their trades short. So sometimes people get into some really great trades, but the fear of not banking that extra capital, you think, well, it's better to bank it now so then I can keep that money. When really, that's a really poverty conscious type of mindset, in the sense that it's a scarcity mindset. You want to be in an abundance thinking mindset of the overall bigger picture, which is why we look at, top down analysis, high time frame structure, which you've learned in episode 3. So once that combines that, you can see, do you see why probability is so important? To think in a probabilistic mindset is one of the most important things. And then moving to overtrading. Really, really easy to overtrade when you're in this sort of sequence. Let's say, for example, you start off with loss, then you might try to force trades, and then again, you start trading more and more. This is assuming, by the way, guys and girls, that on average, you're taking 10 trades. Now, it doesn't have to be 10, it could be 12, 15, but you'll get your average, right? So looking at it from that perspective, overtrading is a really important thing to really learn how to avoid that, and that goes back to the trading plan and all the things that we've covered. Now, when we look at the consistent trader, what would they be thinking in terms of probabilities? They would understand when to trade. So what does that mean? The right amount of planning. They would know how to plan in advance enough to know when to trade. This really comes down to things like impulsive phase, corrective phase, knowing when to take a step back. So for example, if you're taking too many valid trades and we're in the corrective period, well, you're giving yourself a harder chance to succeed because the market's forming a deeper correction. This is where we're forming new patterns. This is when you take a step back, stay out of the market so you can progress. So this is where an experienced trader, someone who's got a consistent mindset as well, would understand, okay, well, let's take a step back now and let's trade when the market gives me permission to do so rather than forcing it, which links to overtrading again. Now let's go to the last part, which is letting the market dictate your emotions. I think this is the most important thing because this is where traders get into this kind of revenge mindset where they take a trade, they feel, oh, the market's against me, let's just take loads of average trades. This is when they go into too many valid trades. They're letting the market dictate it. Remember, the market doesn't know that you took a loss. You have to understand that the market structure, the patterns, they're not targeting you and thinking, right, you took a trade there, we're going to take you out, etc. The market doesn't know that you took 2 wins before that. It doesn't know that, right? So you need to understand, in order to really take a step back, you have to think more neutral, become more neutral with the probable and the possible, which you're learning within the Falcon strategy. Now let's go on to this part, which is trading according to plan. Why is this so important? Well, there's a systematic approach to this. It's so important from the sense that if you take 2 losses, what will your trading plan do for you to make sure that you're on track? Well, it's normal once you take a couple of losses that you might be slightly cautious. You might take a step back and say, right, what do I need to look at here? Were they 2 losses? Do they meet the plan? Perfect. You go over your trading plan and you see, yes, this met all the criteria. So this is the type of trade that I would take over and over again and it still play out. So happy to take that as a loss because that met the criteria. This keeps you on track, more systematic, more mechanical, in the sense it's something you can follow. So if you combined all of that and understand that you'll never know exactly when your wins and losses will come, and you could take the highest criteria quality of trade and it still not play out. Think about that for the moment. These could be the highest criteria of trades that just didn't play out. If you take them 10 times, 8 times out of 10 they play out. Just so happens that the 2 losses happened up front. Does that mean that you take a step back and say, never taking those trades again? Remember, over a large sample size, they play out. And what is a 1% loss and a 1% loss compared to 8 of those trades at a minimum of even 2 to 1? So can you see how mathematically it's within your favor because we have, again, the coin theory, the heads weighted within our favor to give us that edge over time. And just understand, this is one of the most important quotes. You can take a loss on a good trade and you can take a win on a bad trade.